A warm welcome back to life after moving to Canada, and a big thank you for being here and my supporters who have helped me grow this channel. I always look forward to creating new content. Today's video is all about home ownership. How much house can I afford on my income? In this video, I have also included a demo on calculating how much house you can afford. Let's get started. But before we get there, if you haven't done so, please take a moment and subscribe below. This will help me in growing my channel and help you get notified whenever there's new content. Also, feel free to leave me questions and comments down below. I will read and respond to each one of you. Here are my tips on approaching the home buying journey before the actual demo of the tool. If you do not know, I am on my second home buying journey here in Canada. I have tours of my homes in my channel and they're also linked up above here. Tip number 1. If you don't plan on buying your home in cash, start building your credit history. If you're working as a consultant, find out if there are specific conditions when applying for a mortgage from the bank. Tip number 2. Pre-qualify for a mortgage to avoid being disappointed. Do you have a champagne taste on a beer budget? Start with your bank and see what they have to offer you. Tip number 3. Narrow your geographic area. This could be influenced by public transit, schools, or market trends. Tip number 4. Make your must-have list. Where shall you compromise? For example, you may choose not to have a home older than 5 years, must have car parking. Tip number 5. Crunch your numbers. Before you get emotionally attached to a house, do the math. I will now move into the demo. Okay, so let's assume the house you'd like to purchase is about 500,000. Okay, so I'd put that there. Down payment options. So they give you different scenarios here. So would you like to put 5%, 10, 15, and 20? You'll notice down here when it comes to mortgage insurance, the more you put down, the less insurance you need. And if you put at least 20% down of the cost of the home, you're actually paying no mortgage insurance, right? So that would reduce the total cost of your mortgage. So the calculation, this is why I love this tool, because it breaks it down for you. So you can see in total how much mortgage you would be carrying, assuming you're putting this amount down. So moving down here, the amortization period, this is the total amount of time you'd like to spread your mortgage, right? Most people used to have 30 years, but I think now we've moved more towards 25 years. So you'll find most banks offering 25 years. And if I were to choose, a 2.5 rate, the way things have been pointing, 2.5 is not that bad. You can see in terms of a monthly mortgage payment, if you were to put 25,000 down as deposit, this is how much you'll end up paying mortgage. And as you see, the more you put down, look at that. There's such a big difference between the 5% and the 20% down. So, and you can also use the tool to calculate if you're making bi-weekly payments, which would give you how much you would be paying each 2 weeks, right? So assuming we're going with a monthly one, let's proceed. Okay, so now this is the big difference when you're living in Toronto versus everywhere else. So you can see here there's a provincial tax, which I think everybody has, but then there's an additional municipal tax here. And you can see when you choose your city as Toronto, this is what happens. But if you were to choose, for example, Markham as your place you're buying your home, look at that. There is no municipal tax added to that. And it's pretty much double the provincial tax. So it does make a huge difference. So you can also choose here Brampton. There is no municipal tax. Scarborough, as soon as you put Scarborough, that's in Toronto area, Greater Toronto, look at that. You're paying double in taxes. So if you're buying a home that's in the millions, you can see how quickly this number can change and impact your plans, right? Then if you are a first-time home buyer, you do get a rebate, so which is good. So let's go back here to Toronto and proceed with that. And I'm a first-time home buyer, so I will get a rebate. So the tool here asks me, you'd like to calculate how much cash I would need. So it's giving you an estimate, so you see how much house really can you afford. So we're assuming we're going with the conservative scenario here, so we're only putting 5% down. So your down payment is $25,000. The PST, which is tax on mortgage insurance, so you have to pay tax on everything, right? Mortgage insurance is $1,520. Your land transfer tax, $4,475. It hasn't added the other tax, the municipal tax, so you need to add that here. Then you have your lawyer's fee as well as your title insurance. So at the time of closing, at least you need that much, right? So you've paid for your down payment, all your taxes, your lawyer's fee, and double that because you have municipal tax here. So we're talking a good chunk or change there. So what happens if you're putting at least 20% down? This is how the numbers change. So you need a higher amount at time of closing, right? Okay. And for the down payment, you usually make a deposit within the first week. This is how it worked for me, within the first week of purchasing the home. And then no, you need to make one within 48 hours of putting your offer in, and if it's accepted, and then you have your inspections that happen within that first week. You can still back out if something doesn't seem right, and then at the end of that first week, I think is what they give standard, you have to put the down payment. So if you choose to forfeit the offer you've put in, that means you want to walk away after putting an offer in a house you've put your down payment in, the seller can hold on to this amount. Not only can they hold on to it, they can go after you if they decide to sell the house later and they don't get as much as you had offered to pay. So they can come to you for the difference. So you have to be careful there. So moving down, other considerations, you will do that home inspection, as I mentioned, after you make an offer and it's accepted. So you can bring in your home inspector and they can do a thorough check in the house just to make sure everything behind the walls is working as it should be. There's no leakage, there's no mold damage to the house, there was no fire that has been covered up somehow. And then the appraisal fee, for my bank, they did refund me this fee because they have an appraiser go out and actually look at the house, appraise it, so they make sure they're giving you money for a property that actually has that value. So moving down here, your monthly expenses, what do they look at? So you can calculate, this goes beyond just your mortgage. Now you're looking at the whole affordability of this house. So let's go back to our conservative approach. You're putting 5% down. So that's your mortgage, your property tax. When you're buying a house, they do tell you how much property tax they paid for the year. So you can divide that by the number of months in the year, 12. And then monthly debt payment, maybe I have student loans, right? And they cost me 200 to pay back each month. And then my utilities, that's a conservative number, so I'm gonna go in at maybe 180. And this would be your water, your electricity. If you have rental units in your house, let's say the water tank, this would all come out of there. And then your property insurance, this is up to you to get some insurance on your house. You can protect your property or just the property in your house or just the structure itself. And then this is, you know, normally phone, that's very conservative. So let's put 50. I'm assuming I'm in Toronto. And then cable and internet. So I'm looking at about 3,215 monthly expenses when you put everything together at 5% down. So if I go up to 20%, you can see for some reason that didn't change. It did change. Yeah, the less you put down, the more you're paying, right? So 5% will cost you 3,215, and if you put 20% down, I'm paying 2,794. So it's to your advantage the more you can put down as your down payment. Okay, moving down, this is the interest rate risk. So what if that interest rate changes, right? Because you usually lock down your mortgage for maybe 5 years fixed, or there are those who prefer the variable. So what happens if that changes? So you can see some of the scenarios they present here. Worst case, you can see how expensive it was to borrow money. In terms of mortgages, the interest rates were at almost 12%, 1980 to 1990. But current time, you can see we're down to about 2.5. So times have changed, and I think we have it much better than our parents did. So you can see there, you know, moving down, this is how the interest rates have changed over the years, and we're looking at the 5 fixed term. You can see how that has changed over the years. We're at 2021, so we're about here, and they're starting to go up again. I guess that's why it's gone up that way. So if you're looking at how much interest are you paying over the duration of this mortgage, so let's go back to our conservative 5% down deposit, and we amortize for 25 years. So you can see 2021, this is how much I'm gonna pay in total. What's going to the principal amount? 14,433. What's going to the interest? You can see that's 12,122. And this is what happens as you start off with your mortgage. You're paying a lot in interest, so you're almost paying your interest up front. So as the years go by, you start paying more towards your principal amount, right? So if you refinance, you go back to square one. You pay more in interest here. So the breakdown is right here. It shows you, so at the end of your 5-year term here, you have paid 132,777. Of that amount, 75,889 goes to the principal, and your interest that you've paid for those 5 years is 56,889. So I think it really works best for you if you put more money down. Look at that scenario when we change to 20% down. See? Right? You paid a little, at least a little bit more towards your principal and less in interest, right? And you have that much remaining. But if you were to look at it down here, this gives you a better picture, right? So when you'll be done at the year 25 with your mortgage, when it'll be at 0, this is how much in total. If you were buying a house for 500,000, you put 5% down. Let me make sure that's 5%. No, that's at 20%. So if let's start with the 20% actually. If you put the 20% down, this is how much it costs you in the end. So you've put 20% down. This is how much you've paid on your interest because you had a bigger deposit. This is the interest you have paid on that loan that you took out. So in total, after 25 years, you'd have paid $537,559. Right? And that's after 25 years. And assuming that interest rate does not change. So if we go back up again and we go for the conservative approach, I put 5% down. It's going to cost me more, right? At the end of this term, look at that. You're buying a house, $500,000. You've put 5% down, so you put 25,000. So you're borrowing that much. It's gonna cost you almost 170,000 in interest in 25 years. That's a lot. So you can see the difference when you put more in deposit versus, just putting 5% down, which is the minimum. And there are laws that, define if you're in a certain geographical location, how much you're required to put down. So, but it works to your advantage. The more you put down, the less it's going to cost you because you're borrowing less. Okay. So this is a tool I usually go back to. It helps a lot, and hopefully something, if you haven't discovered yet, that you can use to calculate. It can also show you affordability based on your income. Maybe let's put in 100. You have a spouse bringing in maybe 50, and property taxes, let's go for 100. Heating costs 150. I don't have condo fees. My credit card 200. I have a car that costs me 350. And other loans, put 100. How much can you afford? So they're saying here maximum affordability is you can buy a house that much. But we all know there's a lot of unknowns out there. So the more conservative you are, the better for you. So I would, cut that into half or maybe 3/4 and take that as my max, as opposed to, taking exactly what they present to you here. So this is a good tool. If you haven't discovered this tool yet, go out. I am not promoting the owner of this tool, which is realtor.ca, but it's something that I've used. So feel free to go and see if this works in your favor. You can do some estimates there. Thank you for sticking to the end. I hope this was really helpful. As always, don't forget to like and subscribe. See you in the next video. Bye-bye.